Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so the title of this video is it game over for the housing market? How this came about and why we're doing this video is because in our normal daily research where we check out what's going on in real estate in general, I just typed in real estate into Google. And when I did that one, I guess what came up as a general topic?
So I'm going to guess. I don't know where I would get this from, but you got all kinds of negative articles.
Super. I'm going to put them on the screen. I got these three. These are the three that popped up. And of course, a couple of them are from sort of big name papers, one from the New York Times. And I was intrigued by the title of the one from the New York Times. The housing market is worse than you think. Before we get into the details of the article, if you're new to our channel, please subscribe so that you'll get our updates. We do have another Las Vegas mid-month real estate update coming because there's a change happening in the market. We want to talk about it.
And don't forget to hit the notification bell so you get notified when Todd puts the video up.
Okay, so first thing, housing market's worse than you think, New York Times. My first question is, worse than what? And the second comment is, how do they know what you think? Like, how do they know what you think the market is? And how they have to know what you think, right?
Well, they tell you what you think. So that's how they know what you think, because they're telling you what to think. You know, look, William Randolph Hearst was very good about that. He made it a point to make sure to tell people what to think. And he made sure that people read everything that his publications published, because if it bleeds, it leads. And this is exactly what's happening here.
Yeah, so we're going to go through this article and another article. We're going to talk about some of the details in here, because what's interesting is they use these words, but then when you look at the data, it doesn't make sense. Like you go, wait a minute, you just said this and now you're saying this. But we actually have data that looks forward in here that they've gathered. Some of this is from Moody's and places like this that are legitimate real estate data analytics companies. So it's not, and then we're just providing color commentary. We're not making opinions. We're not saying exactly this is what's going to happen or not going to happen. We're just going to provide a backdrop based on our substantial knowledge having done this.
Right. So this is, like Todd said, we do have multiple sources between CoreLogic and Moody's and
Altos Research
and Realtor.com. So we're just looking at all of these and we're just giving you our opinions.
Okay, so one of the first quotes I thought was interesting. Buyers, sellers, and renters are in for more twists and turns as soaring mortgage rates and stubborn inflation signal belt tightening ahead. It can be good for buyers and it can be good for sellers. Like last 6 months ago, it was really good for sellers. It was not good for buyers.
Right.
But apparently it's going to be bad for everybody. They're saying.
There's a reason for that, because if it's bad for everybody, everybody falls into some category. So everybody's going to click on these articles and these publications will get revenue.
Mortgage rates are sky high, prices are sky high, and there's no inventory. We're going to talk about this because we have a chart. Because a lot of you are saying, what do you mean there's no inventory? There's like, I saw a video and there's like all these houses, the inventory's up 40% or whatever. And it's like, yeah, but if there's only one house in the market and you add a second one, then it's up 100%, right? We're going to go into this data because when you see the long-term data and you step back and look at the whole country and look at like the last decade of inventory, you're going to realize it's still really historically low. Here's the other end of it. The quote is, "This may be the worst time in my living history for the home buyer. It just doesn't make sense." So
this person's 22 years old.
So this person's 22. They've only been able to buy a house for the last couple of years. And apparently the plunging prices is going to be worst time possible for, like, you would not want to be a home buyer when home prices are plunging for some reason, because I don't know, but other than interest rates are high.
Right. So look, those of us that have been around the block for a few decades, we do remember times that it was more challenging. Those of you that like to do a little bit of research, do some research between 1979, 1983, and tell me what you find in the comments.
20% interest rates.
And homes were still
going up in price.
Okay.
Because we had inflation. And that's some more stuff we're going to talk about in here. Here's another quote. "Between soaring prices and rising rates," so this was over the last year, "the typical home buyer in October paid 70% more on their loan per month than they would have last year, according to Realtor.com. So a year ago, it was under 3 still. Now we're over 6. It's more than doubled. But the why is it only, if it's doubled, if interest rates have doubled, why is the loan only 77% more? Why isn't it 100% more?
Because you still have that spread of your taxes, insurance, and principal payment.
Okay, so the whole payment's not interest. It's just some of your payment. So you take a good portion of it and double it, and you get 77%, okay? Right. But that doesn't mean that you'll pay that forever, because you can always refi, right? Which is a strategy.
Yes.
Okay. Now, here's the another interesting thing that I thought was a quote from the article. Home prices are going to drop, just not to the extent some buyers have hoped for. Sellers are going to have to work for their closings again, and renters may finally get a reprieve from surging prices, even as prices stay well above pre-pandemic levels. Okay, so let's go through this one at a time. They're going to drop. Remember, the housing market's worse than you think. Prices may drop all the way above where they were in 2020, two whole years ago. Prices are going to fall, collapse all the way above where they were only 2 years ago. That sounds pretty like, actually for me, it sounds pretty bad for buyers, because everyone's waiting for prices to fall. And I know there's people waiting to buy, which is fine. We're never tell you now's the time to buy, but they're basically not predicting like a massive collapse in prices like some other people have predicted.
Right. So look, we're not looking at a massive collapse, because like we've said before, we've got 38% of homes out there that are free and clear, 40% depending on who you're listening to, and then probably another 20% or more that have substantial equity, and over 90% that have at least 10% equity. So we understand that 10% equity could be eaten up by the drop in value. So we're not completely deaf to that, but we're also very aware that more than 80% of the people either are free and clear, or have very little debt, or have sufficient equity to weather even a substantial drop in real estate values.
So Morgan Stanley and Moody came out with some estimates. These are brand new. They just came out. Morgan Stanley, the investment management firm, predicted home prices will fall 7% from the peak pricing in June 2022 to December 2023. So that's between last June and next year. Moody's Analytics expect prices drop 10% from June to summer 2024. So let's talk about this really quick.
So the thing that I want to address kind of right off the bat is they're looking at the top of the market, and then they're saying from the top it's going to drop 7% or 10%. And it's not that your home value from where you purchased it is going to drop 7 to 10%, unless that's when you bought. Let's face it, 99.9% of us did not buy our homes at the very tippy top of the market. So when those values drop, consider that as you not taking that great of a haircut, because let's say that you bought your house 5 years ago or 3 years ago, then you are still going to be up from where you bought it. So it's not going to impact you in that much. It's all kind of funny money for most of us, because most of us didn't buy at the top of the market, and most of us still have appreciation that has occurred over all this time. So we are not actually seeing a drop in our value from where we purchased it. So keep that in mind as you're listening to all these different places telling you about the real estate market dropping and hurting and all these things, versus the impact that it has, the real world impact that it has on you personally. The only way it impacts you is if you bought at the tippy top, or if you're looking to sell and you wanted the tippy top value for your property. Otherwise, the impact for you personally is pretty negligible.
It's actually zero, because there's only 2 times that matter buying and selling a house. The day you buy it,
right.
The day you sell it. What happened in between is not relevant. I still know people that bought their house in 2002 and 3 that watched it go up in value, watched it go way below in value what they paid for it. And here they are, it's now tripled what they paid for it. And they're like, yeah, it went up, it went down, but I don't care because I'm still living here when I do sell it, right? That's one thing. The other thing is people are focused on like the 5 worst markets. Like everyone can probably name the 5. If I said, making the comment, put a note in the comment, 5 where you think the markets are overpriced the most, the 5 worst. You all know, because they always talk about them in the news. So Boise's one of them, Phoenix is one of them. Western states for the most part, maybe some southern states. Vegas might be one of them. We're certainly going to have price declines in Vegas. We've started to see it as more inventory comes on, even though we're at the same inventory that we were at in 2019. We're literally at the exact same number of homes on the market. Interest rates are higher, substantially higher. We might actually see that level off. We're going to know for sure in about 2 weeks. And remember, these are national numbers because we did this other video where we still have markets where home prices are still going up.
Right.
And we personally know of markets where, home prices are going up, and we're just like
the Northeast.
Yeah, the Northeast,
yeah.
and Miami and places like that. That had a substantial thing. Okay, so why is this happening? So we're going to put up this chart and talk about it. This is the number of homes for sale since 1982, okay, in millions, okay? This is the total number in the country. In August of 2022, all the way to the right, 1.1 million. The most that we had at the peak month was 2007. That was when the market was tanking and the market was being flooded with bank-owned homes, which during that period we sold about over 3,000 of them, 3,000 bank-owned homes, listing them, okay? But look all the way back to the left edge of that graph, 1982, about 2 million houses on the market. Wanda, what's changed in the U.S. between 1982 and today? That's 40 years ago.
Coincidentally, 40% is also a number to keep in mind. That's about how much the U.S. population has increased.
So the U.S. population's increased. So when we were a smaller country with less homes and less people, we had 2 million homes on the market. And now we have a little over 1 million homes on the market. And people, if you look at this chart and go all the way to the right and see that little bitty place where it's starting to go up, everyone's just zoomed in and focused on that going, look at home prices. They're going, or look at the homes for sale. They're screaming the number of homes, markets being flooded. But then when you step back and you look at this, you're like, oh, wait, that's just going to turn like every year. It's going to turn and it's going to start declining in. So what's going to happen is we're getting set for this perfect storm. You're being head faked. If any of you played basketball or football, competitive sport, you know what a head fake is. It's this move that you think that something's going to happen. It causes you to do something. And then the player goes the other way, right? Okay. So I think that we're in this head fake, and this is why. The economy is, we have high inflation, we have potential recession coming, and the Fed's been raising rates causing this to happen, causing interest rates to go up. Conversely, at the same time, it just happens to happen in the 6 months of the year when the number of homes on the market climb. If you look at this chart, every year for those 6 months, every one of those ups is spring to fall, spring to fall, spring to fall, spring to fall. Even in super hot markets, the number of homes available on the market were going up spring to fall, right?
Right.
So we're in this head fake where two things potentially could happen at the same time. The Fed could say, okay, hey, we think we've curbed inflation and the market, the economy is slowing, so we're going to start lowering interest rates. And then homes are going to stop coming off the market. And as soon as rates drop, buyers are going to be like, ooh, rates are coming back. I'm going to go back out and buy. So we potentially could get back into this sort of, we look back on this, and we've talked about this for months, and I think we're going to have nailed this. We're in the middle of a head fake in the real estate market, potentially. Potentially.
You know, it's possible. I mean, I think interest rates will still go up higher than they are right now.
Okay.
But I think buyers still have other tools. And some of those tools are variable rate interest loans. Okay. So that's where you go in on a lower rate, and then at some point in the near future or in the midterm future, your interest rate increases. But the idea is that you can get in now, you can afford the payment now, and then by the time that your interest rate resets to a higher interest rate, you can refinance, and mortgage rates hopefully have dropped, and your world will be well. This is actually happening more and more, that we're looking at close to 17% of loans out there now having variable rate interest rates. And to give you perspective, back before the great reset of the housing market back in 2007-8, about 30% of loans were variable interest rates. So we're not at that point. And remember, the lending standards are completely different now than they were then. So these loans are not as they're not as predatory as they used to be, and I use that term actually on purpose because I am very concerned about predatory loans, but I don't think that these are quite the same thing because the lending standards are a lot tighter. I also think that within the next couple of years there will be opportunities for people to refinance and control their spending on their housing. I'm generally not fond of variable interest rates for mortgages because I like it when people have control of their housing costs. I think that's a very basic thing in order to have peace of mind as far as having a roof over your head.
Another quote from the article, this is about weakness in sales volume more than sales prices. Okay. Mr. Chagra said, adding that forces cause prices to plummet after the Great Recession, irresponsible lending and a glut of supply aren't in play. So we don't have irresponsible lending, it's gone. We don't have the ton of supply, it's gone. We actually have less than a third of the number of homes on the market that we had back then. And when people say, yeah, but they're going up. Yes, in about 20 markets, they're going up pretty strongly. They do go up every year.
But having more inventory is not a bad thing. It just gives people some choices. I think that's one of the issues to kind of keep in mind. We still have historically low inventory levels, and having more inventory, not an obscene amount of inventory, but having more inventory is a good thing. It keeps the market healthy. It gives buyers choice. Those are good things.
Yeah, I agree. So we're going to jump on to the second article. New data suggests serious real estate market correction, a serious correction. So I wonder how they define serious.
Probably not a clown's nose.
Probably not a clown's nose. Okay. The first quote, pending home sales in the United States dropped 35% in recent weeks compared to the same time last year, according to data from Redfin, major real estate company. Now you all know who they are. Okay, two things from this. They dropped 35%, but not prices.
Right. So they're saying that the amount of homes that have accepted offers dropped by 35%. But remember, what did we have a year ago? We had crazy time a year ago where people were physically lined up around the corner to see houses, where houses were getting 80 offers. A third of them were sight unseen. So no, we don't have that market. We have something that more closely resembles a normal market, a natural market, a market where a buyer and a seller have a reasonable negotiation regarding the transaction. It's not one-sided. It's a lot more fair.
Yeah, I agree. Here's another quote. This is another one. We expect 5.2 million homes to be sold in 2022. That's in the U.S. This is about a 15% decline for 2021. But 21, like Wanda said, the hottest market ever in the history of real estate was last year, okay? Because interest rates were still low, and that's what caused home prices to go up. They're just
right.
These homes weren't coming on the market fast enough, so anything that came on the market was getting purchased. Right.
Look,
because remember, you have people locked in at these I just met a person. They have a 2.65% interest rate. 2.65. Their thing to me is, I will never sell this house. If I move, I'll keep it as a rental. Because why would I want to get rid of a house that I have a 2.65? You're never going to probably borrow money that cheaply again, right?
Right. I mean, it was basically free money.
Okay. And then it said, even fewer homes will likely be sold in 2023, about 4.8 million homes. But that's okay. So we're going to have 5.2 million homes sold 2022. That'll be the second most number of homes transacted compared to 2021. They're expecting 4.8 million, but that's still a lot. Is a percentage that's over 90. That's less than 10% less. It's less than 10%. So 15% decline in total sales and less. What this means is there's this locked up amount of tell them about the inventory that's sort of locked up that's never going to come back out, and what are some of the reasons why there's homes that are probably never going to, because normally we have all the homes in the US churn because people sell it when they move, and that's stopped. Why is that stopped?
So we have two sets of homes that are, to Todd's point, locked up. We have one set that's owned by institutional investors that those homes are going to stay locked up for a very long time, because even when they do change hands, they will not change hands to individual purchasers. They will change hands as a portfolio to another investor, so those will not change hands to individuals. The second one is, of course, everybody with what I call free money. Look, if your interest rate is 3% or and change or below, you're basically borrowing money free, and unless there's some massive life circumstance change, you are not getting rid of that loan. Now, what that means is that because you're not going to sell that house, now you're going to have to make other arrangements for your move-up house or whatever else. And so what's going to happen is your home is not going to come on the market. That home's going to stay, whether you're going to live in it or you're going to rent it out, whatever you're going to do with it. And then you're going to maybe delay that move-up home, or you're going to go with that move-up home with the understanding that you're going to be maybe paying substantially more for a similar home than what you're paying for your current home. So there's a lot going on in there, and I think that's something to really keep in mind, that this tradition for U.S. sellers to sell a house and buy their move-up home, that for a while is not going to happen. They're not going to sell that 3% or below interest rate home. So either they're not going to go to the move-up home, or if they do, then this home is not getting put on the market, and they will find another way to pay for that move-up home.
Here's another quote from the article. In other words, home prices are rising, but not likely as fast as they were earlier this year. Remember, this negative article talked about the serious correction. And we expect by the end of the year, home prices will decelerate even further. So when they won't decline, they'll decelerate. We expect to have about 5% price gains by year end. So that's 2022, January 1st to 2023. So they're saying that the housing market it'll decline from here, but it won't give up all the gains from last year. It'll still be 5% above it. It also says that they expect in 2023, they don't expect a price drop. They expect home price to be relatively flat. Nobody knows for sure, but they're literally not even predicting home prices falling other than from the peak in 2022. Year over year home prices, they're still saying that they're going to keep climbing, but that's a serious correction. And remember, this is nationally. This is not, don't say Todd said in Las Vegas the home prices would be up, because we get accused in the article of saying you're lying, they're not going to go. We're just saying what the article, what these researchers and people have said. After they put this super negative headline, then they said, oh, hey, but we think prices are going to be up a couple percent. And anecdotally, we've sort of seen in other markets, not in Vegas, but in other markets, even in over the $1 million price ranges, like houses still disappear off the market pretty fast.
Look, I don't care where you are. If you have a great product, people want to buy your product. And if that product happens to be a great house, you will have people who want to buy that great house. Another
quote, at a broader level, Evangelo says she also doesn't expect a repeat of the 2008 as a result of the recent downturn. We all know that because it's nothing like 2008. It's literally the Fed has decided to come in here, and it's sort of a little bad timing. Head fake, like I said before. That's my prediction, head fake. And here's the other thing. This is the best quote of the article. Remember, 2021 was the best year in the housing market since 2006. So we expect to have this slowdown. Like, literally, we said this. You can go back and look at our videos from 6, 8, 9 months ago where we said, look, the home prices could go up, but they're not going to keep going up at 20%. And all of our predictions about what home prices would do in the future would be that they do not keep going up at this rate. Neither one of us said, oh, they're going to keep going up at 20, 30% a year, because they've gone up 50% in the last 2 years.
Right.
Right.
Yep.
Okay. So, Juana, where does this leave us? Where does all of this leave us? We've gone through all this data. We've talked about everything. We have that chart. I'm going to put the chart back up here again. This is the chart that shows the ridiculously low amount of inventory that we currently have. And what I want to do is a follow-up video in 6 months where we go back and we pull the data and talk about, because I think it's to be very interesting in April and May, because if interest rates are less, can you imagine an April and May when interest rates are at 5%, even if they're higher in the medium term, and we have less inventory than we have now? What does that sound? What does that boil down to?
So if we have 5% interest rates, really at any point next year, I think you're going to see this rush to market for all these buyers that are going to come to market and go back to driving a market with multiple offers and all of that all over again, because there are a lot of people who feel like I missed that train, and if it comes around again, I'm not going to miss it again. But, we do go back to what we said before. If it's the right house for you, marry the house, date the interest rate. There are products out there to help you out. Not every time, not every moment in history is a good time for you to buy or sell, but that's very personal to you. It does not necessarily apply to the person sitting next to you, because everybody's situation is unique.
You know what's funny? If I get asked this all the question, is it a good time to buy? And I'm just going to say this. Would a year ago today have been a good time to buy? Would you have bought a house cheaper at a better interest rate? Yeah. What about in 2020? Would that have been a better time? Would you have bought a house cheaper for a lower interest rate? Yes. What about 2019? I could go back 10 years. Literally, you could have bought a house at any time in the last 10 years. But you couldn't have said in 2011, hey, interest rates are 4.5%, and should I buy a house right now? Like, is this a good time to buy? Because no one really knows. But what's funny is when you step out and you look at the entire housing market, knowing what we know about institutional buyers, about this housing inventory that's locked up, that is going to be very difficult it's not just going to churn. Mm-hmm. We also know that new home construction is now plummeting because it's too expensive for builders to build. They can't borrow the money to build. Mm-hmm. And that's just going to make the long-term thing work. We talked about that. Of course, we're very bullish on housing. We've been doing this for 20 years, and we sold thousands of houses. We flipped houses. We kind of understand how all this works. Mm-hmm. But I think, that I definitely think that a couple things hit the housing market at the same time to cause this little, slowdown that we're in. Mm-hmm. Definitely a reversal. Definitely has taken off the foam off the top of the market in a bunch of key cities where home prices were in. We're in Vegas, so we've seen it here. So just so you guys know, our business is we list houses. We're the listing agent. We put the house in the MLS and we negotiate the offers that come in. So we get to see all of the interesting stuff that happens on both sides of that, where it's the multiple offers or, not getting many buyers and trying to, get chipped away on the list price and things like that. And we've definitely seen that. We've definitely watched that. We've watched prices go down. We said on a video a few weeks ago, maybe a month ago, we think there's a 4-month window when prices will probably keep coming down potentially, and there will be some opportunities to buy even though interest rates are high. Do I think you would get a better price in December of this year versus December of 2024, 2 years from now? I mean, historically, would say yeah, unless some black swan event happens. If you had to say, well, what about December of 2032? I'd say 100%. We sold 0 of our rentals knowing everything we know about real estate. We didn't sell any. We didn't tell our investors to sell properties, even though we would have made a ton of money if they'd sold their properties. And we didn't tell all of you to sell your properties.
Right. So we don't tell you what to do. We give you information and we empower you to make your own choices. Yeah. If you like the video, please hit the like button, hit the notification bell, share the video if you think it's useful information, leave us comments, tell us what you think. We like reading your comments. We try to respond to as many as we can. Feel free to look at some of our previous videos and give us feedback on those, because we will check those comments as well. And if you want to give us suggestions for future videos, we do listen to you and we do try to please you and get those videos out to you. So we'll see you on the next video. Bye.
Bye.